Welcome back to Turpentine VC, the podcast where we discuss the art and science of building successful venture firms, VC to VC. Today, we revisit one of the best Turpentine VC conversations, an interview with Roger Ehrenberg, founding partner of Eberg Capital and IA Ventures. Roger is widely considered the best seed investor in the business, with renowned investors Mike Maples Jr. of Floodgate and Chad Byers of Sousa, both citing him as the gold standard. In the conversation ahead, Roger shares the secrets of his seed strategy that's netted him 10x returns. He offers valuable insights on how seed funds should operate in today's market landscape and provides his contrarian perspective on various investment approaches. Please enjoy the episode. Welcome to Turpentine VC. Thanks so much for joining.
Thank you, Erik. Great to be here.
So I just had Mike Maples on before you, and he unwittingly said that you're the investor he perhaps most admires because you said what you were going to, you were very specific about what you were doing, what you were not doing, what you stood for, what you didn't stand for, and you didn't waver. And you had phenomenal results to show for it. I believe, 10x funds. Why don't you talk about what that firm's strategy was exactly?
Sure. So I had this deeply held view that running a concentrated portfolio at seed and being ownership sensitive was ultimately the way to give yourself the best chance at outsized success. And my goal was never to try and stamp out 3x funds. It was to try and create discontinuity, kind of maximum convexity in the portfolio. And rather than having a series of smaller, option bets, it was really much more a function of both acknowledging that the most valuable resource that myself and my partners, Brad and Jesse, had was time, really not money, and that we specifically focused on companies that sat at the intersection of what we perceived to be not well understood. And yet, if their hypotheses were correct, that there was a massive market opportunity that was there for them, but at the same time where we felt our greatest value was in helping those founders design the experiments to determine product market fit. So we always would invest pre-product market fit. We're not providing scaling capital. We're providing, can this actually be a real business capital, and does that then warrant additional money to peel back the layers of the onion to see, can you actually create a category defining company?
And so in 2023, do you think that strategy would still take hold? We've seen seed change a lot, right? Multi-stage firms have gotten into seed. There's a lot more capital. Sam Lessin recently wrote that he thinks it's the end of seed, but he particularly thinks end of seed in terms of club deals. He thinks you can only do seed in the way you did it, which is contrarian, and right. How do you think about seed today with the rise of super angels, et cetera? Do you think that strategy holds up?
I do, and I think very few firms do it. And why? Because it's hard, and it's putting your eggs in a relatively narrow basket. And I think that makes most managers, especially first-time fund managers, very uncomfortable. That what feels safe when one gets into business is to tag along with demonstrably successful investors, or perhaps even more truthfully, investors with bigger names and brands, forgetting about success in the way that high-quality LPs measure success, notably DPI. And I think it feels comfortable to be with the crowd, because if you're wrong, everyone's wrong. And if everyone's right, you're right. So it's kind of a seemingly less risky strategy when one is trying to get in business and not screw up too big so you don't get a chance to even have a second fund. But the reality is, to me, the risk is almost the exact inverse. The real risk, especially if you have LPs with any sophistication, is that if you're not taking true pre-seed and seed stage risk, which means not just the companies, it means the ownership, the check size, and the conviction, where you're going to actually allocate your scarce time And the way that we talked about it at IA was really bending the curve. That if we didn't feel that we could bend the curve for a company in that pre-seed to seed stage as they're going through this kind of experimentation process and sprinting towards product market fit, then unclear whether or not we were really the right investors for that company. And I would say today in my own investing, I still follow a similar strategy. So, which is all to say, Erik, I think that, and the data bears this out, one of the features of our favorite LPs was their willingness to share data with us on their historical experience with managers across decades. And there is something about concentrated seed that occupies this unusual place in the 2x2 because you really you are taking the biggest risk, but you are generally getting compensated for it. Whereas at the Series A and often at the Series B, you're paying much higher prices without a similar amount of de-risking. And I think that's really the key, is that many larger multi-stage funds will invest in A's and B's without really pricing the risk reduction from seed as you think about that valuation versus the seed valuation. So we always lived in that very early, very risky miasma, teams forming, ideas gelling, plans codifying. But boy, if you hit it, then you can really hit it.
Right. And yeah, it's interesting because there was a ton of capital that flooded in over the past few years. One of the things that we did at our firm was we were seeing that follow-on rounds were happening increasingly earlier ahead of any de-risking of for these companies. And so it actually made more sense to allocate the follow-on dollars to new companies so we can get more shots on goal. And just because these follow-on prices didn't make sense. I'm curious if you would have advised against that or how you think about that for you if you were starting IA today, given sort of how much capital has flooded into the ecosystem.
I think your adaptation makes sense. I think it depends on how horizontal your portfolio is. I think what IA did was severely cut velocity to almost zero, and then would just be wildly selective about even that first check in a market where even those first checks are getting priced at largely irrational levels. And I think the current market is kind of bearing that out now that we're in the midst of this correction, or one might say rationalization. What I think an adaptive strategy in this environment is for a manager that runs a concentrated portfolio and has skill in helping to assist leadership teams with hard questions of resource allocation. Do you narrow your scope in an environment of scarcity and go deeper, or do you try and go more horizontal and to build brand that way and to kind of believe that you're best positioned for the next phase of abundance because you've created a broader footprint? Those are really hard questions, but I think the best opportunities in this current phase aren't necessarily net new companies, but investing dollars in existing companies at depressed prices when the businesses themselves are simply taking longer to gestate because they might be platform type businesses, which, as you know, if you're actually building a platform business, I mean, it could take 5 years to actually create the critical mass. Or if you're, building something that is around, open source or developer tools, and you need that community evangelism and you need a large enough user base to get that flywheel going. Like, these things just take time. But in a market like this, it's very painful to give companies like that the appropriate resources and the time necessary to achieve their potential. So that's when tremendous opportunities exist, when it's almost like dislocation in the opposite direction, where the potential of these companies relative to the price is massively skewed in your favor instead of the converse when you're reaching to invest in companies when valuation's moving away from it.
I see you as a true craftsman investor. You have an idea of what it means to be a good investor, an idea of what it means on how to win, and you've won. And so that's only been confirmed, and it works in rational markets better than crazy markets, but where it works in all markets. Whereas there are other, I'll give YC and Andreessen as other examples where it's almost like they're playing a different sport. YC in particular is obviously playing a hugely horizontal huge high volume game. They have special economics. They don't invest in the way that you invest, but they really focus on sort of the product to entrepreneurs and this heavy services approach. And Andreessen at the later stage, and they're playing this massive AUM game. And is your analysis, hey, different? Like it's a different sport, but you can have multiple kinds of winners. I've wondered if the future of venture is going to look more like the craftsman approach that has won for so long, or more like the sort of product or platform approach that is a bit newer, but is getting a lot of dollars and has some flashy wins. What do you think about that?
Erik, that is a fantastic question, and this is one of the times when my being old and having been through so many cycles and been in so many corners of the financial markets, I think I've actually got pretty reasonable perspective on this. The answer is there is no one prevailing regime. It's cyclical. It's based upon interest rates, investment alternatives, PR, and a host of other factors. But certainly the most notable is kind of interest rates and macroeconomic environment that drives interest in these, long duration, less liquid asset classes. So I would posit that the venture world is no different than the public equities world when it comes to its shape and how things move up and down and firm types and preferences shift. But if you look at some truly great generational firms that have literally done the same thing from inception, like take Baupost Group in deep value long short. Okay, so Baupost has been doing their thing for I think 40 years now, let's say. And their relative returns would go up in down cycles and go down in up cycles. But net, if you look at the rate at which capital compounds, and again, I'm not an LP, I just know from being in the hedge fund business, like Baupost was always just unwavering in their strategy. I view us in venture in the way that I view Baupost in the hedge fund arena, which is they stayed relatively small. They've generated tremendous returns over long periods of time. They've obviously built a culture of success where they could continue to elevate young talent and to continue to be great stock pickers in all markets. That is what I set out to have IA be. I think Brad and Jesse are carrying that along brilliantly. But I think there will always be the YC types in the world. You could argue Vanguard, right, kicked off that incredibly horizontal approach to investment management, right? And then you've got these very narrow specialty managers. So I think it's all part and parcel of the same thing, which is there can be these multiple strategies that are also servicing different types of investors. Like, let's face it, if you're a certain scale of LP, you can't really invest in IA because we're just too small, and the check size that you would want to write, we simply won't accept. So then Andreessen, with their infrastructure and they're a corporation, right? It's like, but they are institutionally investable with enormous dollars. And if they can, put up good returns, they don't even need to be great returns. Good returns in this multi-product array that they now have, then that's great for what many institutions want. YC is much more geared towards not the investor, but the founder. And they've created this ecosystem. And if, I look at kind of what I would consider their unfair advantage to be at this point is cohort after cohort that have extraordinary individuals that have built some really tremendous companies that then feed back into the ecosystem. And they've done a brilliant job. I mean, what different people think different things. That's something I respect very highly, is that they really have built an ecosystem that is unrivaled in venture.
Hey, we'll continue our interview in a moment after a word from our sponsor. Managing company expenses doesn't have to be a hassle. You can effortlessly streamline the entire expense management process, from receipt capture to approval routing and reimbursements, in a single solution. Enter Rippling Spend, the revolutionary platform trusted by thousands of businesses to take control of their finances. Backed by top investors and boasting over $1 billion in funding, they're dedicated to providing exceptional value to their customers. Here's how it works. An employee submits a lunch receipt via their Rippling app, and AI instantly turns it into an expense report, checking for policy compliance in real time to auto-approve or send directly to the approver based on your org chart. No more chasing receipts or manually routing approvals. Want to take it a step further? Automate your corporate card management with Rippling as well. You can automatically issue cards to employees with preset limits and specific policies, such as managers with a $50 team lunch limit. The rest is auto-rejected at the point of transaction. Then, every transaction syncs with your accounting system in real time. Plus, you earn market-leading rewards on every purchase, rewarding your company for everyday spending, all while closing your books 3 times faster. Ready to transform your company's spending? Sign up for a free demo at rippling.com/turpentine and get 1 month free. That's rippling.com/turpentine. Start your 1 month free trial today. Hey everyone, Erik here. In this environment, founders need to become profitable faster and do more with smaller teams, especially when it comes to engineering. That's why Sean Lanahan started Squad, a specialized global talent firm for top engineers that will seamlessly integrate with your org. Squad offers rigorously vetted top 1% talent that will actually work hard for you every day. Their engineers work in your time zone, follow your processes, and use your tools. Squad has front-end engineers excelling in TypeScript, React, and Next.js, ready to onboard to your team today. For backend, Squad engineers are experts at Node.js, Python, Java, and a range of other languages and frameworks. While it may cost more than the freelancer on Upwork, billing you for 40 hours, but working only 2, Squad offers premium quality at a fraction of the typical cost, without the headache of assessing for skills and culture fit. Squad takes care of sourcing, legal compliance, and local HR for global talent. Increase your velocity without amping up burn. Visit choosesquad.com and mention Turpentine to skip the waitlist. Now, most venture capitalists are not macro thinkers or don't have the type of experience that you do, but you are a macro thinker. And so when you think about the next few years, and obviously no one's a predictor, but you're a student, how do you expect what's going to happen in macro what kind of ripples is it going to send through the venture ecosystem in terms of what kinds of players it's going to favor, maybe what kinds it's going to hurt, or what mental model of macro should VCs have as they look at the next few years of venture capital?
Definitely a defensive posture. I think that, again, so much is driven by rates and global sentiment, long-dated rates, not Fed policy. And look, I mean, if SOFR was 6 and the 30-year was 3, I would feel very differently. But with SOFR at 5 and change and the 30-year well above 4 and mortgage rates over 7 for the first time in 40 years, like that's a tough environment, right? Because we are, as a general matter, in a more risk-off culture when it comes to illiquid assets. In liquids, we've seen, the equity markets, the large mega cap techs had a bid for a while. It's softening now, but in general, I mean, it's been pretty good. But long duration assets have generally looked like crap, and that's the intersection of poor liquidity and uncertain prospects. So not really knowing how macro is going to affect growth rate, which of course the two biggest things with a long duration equity like a venture backed company is, growth rate and interest rates. Those are really the two salient financial factors. So what I had alluded to earlier about the best place to deploy dollars right now is probably in your best companies, and to be extremely careful with net new companies to the extent that they're capital intensive. If you back teams that are unbelievably scrappy and can really build a lot for very little, and you feel like you've got very strict parameters around which you're willing to write an additional check to continue to fund that development, again, in an environment of scarcity, then I think probably the best risk reward is fortifying your high potential companies that you've already gotten to know over years and years and years.
Fascinating. And give my audience a little bit of a mini macro lesson in terms of you close the loop or flesh out more about how higher interest rates or lower growth rates, like how that affects the venture ecosystem exactly. Kind of tie that thread together.
Sure. So they both ultimately get to the same concept, which is terminal value, and what is the multiple that an investor is willing to put on future cash flows. And when you have attractive, low risk investment alternatives that are yielding a high rate, and in our case, the highest rate that we've seen again in decades, then cash feels pretty good in a scary world. And that's going to mean that the risk premium that you're going to charge on long duration equities is going to be much, much higher. So then we get to growth rate. Well, so that means that you need extraordinary growth rate, like the 10% month on month, not from C to A or A to B, but from B to N. So something that really has tremendous nonlinear growth, which again is very, very hard to find. I mean, there have been companies like a Snowflake or something like that have exhibited these unbelievable, or even for a period, a Datadog, right? That just crazy, crazy growth, even at scale for an extended period of time. Those are companies that they will not trade anywhere near what they would have in a lower rate environment, but they will still trade at premium multiples. But unless you're one of those companies, then growth rate and interest rates are going to drag down that terminal multiple, which is going to drag down the present value of your future cash flows.
That's a helpful overview. And do you think that interest rates have been artificially low these past few decades? My economist friend Scott Sumner thinks that maybe perhaps they weren't low. Maybe perhaps thanks to demographics or productivity or other factors. Maybe we just have lower rates from now on.
I would say yes and no. Now, look, I'm sure your friend is a trained economist. I'm not a trained economist, but I would say it can't be either or. Certainly, the global growth rate is slowing down. So global GDP is slowing down as the population explosion slows down. And now we're even seeing in the company that had the greatest growth in history, China, their growth is waning and they're in deep trouble because they've had this massive demographic shift against a wave of overinvestment that's going to have ripples across the globe, as we're already seeing today. So that's certainly part of it, but it can't be disputed that in just talking about US policy, that the US very intentionally and Western Europe very intentionally ran loose money policies in order to keep interest rates towards zero, especially coming out of the global financial crisis. They had been low before them, but they were not crazy low. But we had more than a decade of that bubble inflating of literally zero interest rates that made investing in long duration equities and other risk assets so compelling. So you get exactly what you have today, which is the bubble coming out of the balloon, incredible pain. I mean, I remember I was sitting on a panel with Fred Wilson. I think this is probably in 2010, coming out of the GFC. And, what is venture investment going to normalize at on an annual basis? And we were like, yeah, maybe like 10 billion. 10 billion? I mean, I was 10x off that one. I mean, but by the way, if I had known what Fed policy would be, I would not have said 10 billion. Maybe I would have said 30 or 40 billion. I would not have said 10. I would not have thought it could be 100. So I was like orders of magnitude off because I could not have foreseen that the Fed would keep rates at zero for almost 15 years.
If let's say you have to make a prediction now about where they will normalize, knowing what you know now about how the Fed has acted and what played out, what prediction would you make?
I mean, so I just haven't looked at the statistics lately. So I mean, obviously, I know that venture investment in 22 and 23 has fallen tremendously. I don't know what it is now. If you tell me what it is now and what it was at its peak, I could tell you. I think it's going to be significantly lower. I mean, I just do not think that there's going to be a ton of net new investors coming into venture right now. I think, and you can see it, so where is some of the biggest money going right now? It's going into real assets. It's going into things like sports, or it's going into intellectual property like media rights. And I think there are other mega trends. Now, clearly, AI occupies this unusual place in the universe right now where it has largely been immune to the cyclicality and volatility of venture investment. But there aren't too many sectors like that. And there's always one, right? Whether it was clean tech, machine learning, big data, whatever, and now it's AI. So I do think that the biggest pockets of capital right now are not really focused on venture.
Right. Because even with AI, it's unclear how many amazing startup opportunities there will be as opposed to just going to the incumbents.
I agree with you. Right now, I don't know how much true white space is left in the Venn diagram with, 200 new circles having been created over the last 18 months.
And so if your prediction is correct, what does that mean for the A16Zs, the YC, these massive kind of AUM platforms? Do they struggle, or do they have to reset their strategy a bit?
So I think with folks like that already have an embedded LP base and they're just cranking out new fund products, I think they'll be fine because, again, they are institutionally investable. My hypothesis is that these LPs are underwriting these firms for a generation. They are not tourist VC investors, and as such, those are not the firms that are going to be hurt. I think net new fund creation is going to be hurt. And if I'm totally honest, Erik, and I said this 5 years ago, there are too many firms. And when you have taxi drivers and Uber drivers talking about their venture investing in the same way that, when they talked about, crypto with Bitcoin at 60,000, again, this is not a new movie. We've seen this movie 1,000 times before. You don't, in the same way that you don't need as many banks in the country as we have, you don't need as many seed stage venture funds. You just don't need them.
Totally. It's I'm going to make a joke of an analogy only because you said you're old. I remember this video around this kind of veteran or very old man who looks at the state of America today, and he's very sad. He says, we didn't go to Vietnam for this. It's kind of this and meant to be this moving video. And I'm sort of imagining you looking the last 5 years of venture or maybe past decade saying, oh, I can't believe it went like this. It wasn't supposed to be like this.
You make me sound like one of those old guys, and I can't believe the industry's unfolded this way.
Yeah.
I mean, okay, well, you're right. That is exactly what I would say.
Yeah, all these players who made all this money maybe in the wrong way, or I don't know, just yeah, is that kind of your experience?
Like AUM. I mean,
Yeah.
that's the thing, man. It's just I have such a hard time with it. Now, look, again, it's Andreessen is very particular. Like they are a multi-strategy, multi-product institutional investment management firm. They are not a venture firm, as far as I'm concerned. So forget about them. But then if you look at the rest of the industry and you look at what I believe is the lack of LP discipline in just signing up for fund 3, 4, 5, 6, 7, 12, 15 of name your venerable venture firm, and you look at the returns, with a few notable exceptions, they're not good. And to me, I never understood that. Now, I've never been an institutional LP marshaling dollars of that magnitude, but somehow the GPs were able to create this illusion that, and it can't be true, that all of these funds are so special and all of this capacity was so valuable that, well, if you don't re-up, well, then we're going to give it to X and you'll never get to invest with us ever again. The GPs were masterful at that. You're talking about hundreds of billions of dollars over the last 20 years in these kinds of funds. Which again, I feel so grateful for the LP relationships that we established and cultivated at IA, because we were extremely focused on getting a set of partners, firstly, who we viewed as true partners, where we wanted them so they could mentor us in ways that we needed help and support. And believe me, we needed a lot. And we still learn a ton from our LPs. But where they, even as large institutions, viewed, a 20, 30, 40, $50 million allocation to IA as being incredibly valuable. And yes, it's not a $200 million allocation to $1 billion fund, but it's huge to us. And look, if we can generate what we've generated so far, then that's a lot of absolute returns for these causes that we believe very passionately in. So I just think the whole market was so distorted on both the GP and the LP side, and now that reckoning is happening. And even though it's painful, I think it's ultimately a really healthy thing.
Yeah. And others like Bill Gurley have been talking about it for needing to happen for a while. And yeah. And so you're encouraged by sort of this forced discipline that is going to have to come back. You mentioned crypto. I believe that you guys got into crypto as well. You mentioned sports. You guys are focused on sports now, and obviously it's both to make money, but also a passion project with you and your family. Any reflections on getting involved in crypto a bit, or what you learned about it from a meta perspective, and also then let's talk about sports.
I view it in kind of three buckets. There's crypto, NFTs, and Web3. So crypto, just Bitcoin, Ethereum, whatever. I traded some of that pretty well. Cool. But that was purely a short window in time where I felt like I had a deeply held view about the way things would go, took my gains and stopped. Right. For me, it's not a religion. It was an asset that had an observable value. It had a trend in the sentiment, and I traded against that and made some decent money, and then said, okay, I'm out. So that's crypto. Then there's NFTs and projects. My sons, Andrew, Ethan, and I spent some time looking at different projects and invested in some. And I would say that we did a relatively shitty job pricing those projects rationally. I think we got caught up in some of the hype and the shifts in sentiment, and it was a great learning experience. That was that foray. And then Web3, more like core infrastructure. We've got some investments there that are good, and that's more like venture. But it's something that, was this sphere was kind of the initial engagement with my sons in working together. Now transitioning to sports, I had kind of put a stake in the ground as I was then transitioning out of IA. I had the opportunity to invest in the Miami Marlins. The now chief commercial officer is my wife's first cousin, somebody I've known since he was 7 years old. And so they were really just looking to raise friends and family money from around the table because didn't want to do a capital call during COVID. And it ended up being a really good opportunity, and we're a huge baseball family. So it was kind of the culmination of one of those fantasies that you think will never in a million years happen, and it happened. And so continue to be very involved with the team and ownership today. Since then, I really codified this thesis around this, what I call the entertainmentification of sports, live sports, sports betting, sports media, sports data, all working together in this kind of network effect, almost, not like a YC, but in the sense that we have built this almost like a little keiretsu of our companies having these strategic overlaps where they're actually working together, not because they're Eberg companies or not because I tell them to, because it's actually great to work with a friendly who is synergistic with what you're doing and you share Eberg in common. And so, around the biggest sports betting conference in the tri-state area, we held an event that 75 people come, a bunch of our companies, some franchise owners, other big investors, sports media, and it was amazing. And to see the energy, to me, that business feels a lot like going to tech meetups in 2008.
Yeah.
And so, we've now built this portfolio where, we have baseball team, investor in an MLS team, investor in an F1 racing team.
Wow.
And then having these sports betting investments, sports media, sports data. That's really where the boys and I are spending our time. And it has been and is super fun.
Yeah, I can imagine. It's I at one point wanted to be an NBA player, and of course we all reach our limitations there. Then I wanted to be a coach and realized I didn't want to slog for 20 years just to maybe have a chance to do something. And now I want to own or invest in a team someday. So I'll slog in startups and hopefully I'll be where you're saying at 20 years. And you think it's such a compelling opportunity today, or in terms of why capital is flocking? One, because it's entertainmentification. Two, just because these are scarce assets. Put a little bit of meat on the bones of why should more people be getting into this space? More investors, more, our listeners, should they be thinking about this?
I think so, and I think it's starting to happen. I do. Erik, it's so weird, and it almost sounds too strange to be true, but it is true. Every 17 years, I have a feeling. I had a feeling about, going to Wall Street and getting into derivatives. Then I had a feeling about leaving Wall Street and getting into seed stage tech. And then I had a feeling about leaving seed stage tech and going into sports. So this is my third cicada cycle. and every bone in my body is telling me that this is the megatrend of the next generation. Partly it's due to scarcity. But at the same, and now you're talking about sports franchises. So there's different layers to it, obviously, in the same way that there is with any megatrends, not like seed stage tech. There's layers to seed stage tech and what made it such a compelling opportunity. So certainly like major sports franchises, there is scarcity, and there's way more ways to promote and monetize and build much broader audiences than even 5 years ago. So I think that's what continues to drive franchise values, even as cash flows for many aren't great, but asset value continues to go up because of expected growth of those cash flows. Then you have all the stuff around live sports, like sports betting. And you had DraftKings and FanDuel that in this country that have been around for more than a decade, but they existed in the pre-PASPA Supreme Court ruling in 2017 that then opened things up. So now you have, legalized sports betting in more than 30 states. You have daily fantasy in pretty much 50 states. And it's just the whole TAM has exploded. And the reality is, with the intersection of the kind of social tools that people use today and sports betting and the ubiquity of live sports now being accessible on your devices, wherever you are, whatever you're doing, multi-screen, it has created this even deeper engagement with the live sports themselves to be able to bet on them and share with your friends. It's like buying a movie ticket, right? This isn't degen betting. This is entertainment betting. And it's just becoming another part of the entertainment experience. And then, so there's all that. And then it's like, okay, well, if you're going to have this thirst for sports, the majors don't provide a full calendar up and down of programming. Well, what then? Well, what about the rise of alternative sports? And now you have all of these niche sports coming in. By the way, when I say niche, there could be tens of millions of followers on social, like World Surfing League. Let me tell you, man, those are passionate people. Right, WSL, it's a thing. Or PBR, professional bull riding. And it's unbelievable, Erik. It's all over the place. And it's team ownership, it's media rights, it's branding, it's merch, it's betting, it's everything. So in any event, you can see I'm very excited about this, and this is literally where I'm spending almost all my time these days from a business perspective.
That's very exciting. That's a great note to wrap on. That's an overview of a space I hadn't considered a ton, despite being a big fan of it. So excited for me and my listeners to dive deeper into it. Roger, thanks so much for coming on the podcast and sharing your enthusiasm and your earned secrets and wisdom with us.
My pleasure, Erik. Thanks so much for having me.
Turpentine VC is a podcast from Turpentine, the network behind Moment of Zen and Econ 102. If you liked the episode, please leave a review in the Apple Store or rate us on Spotify. Hey everyone, Erik here. At Turpentine, we're building the first media outlet for tech people by tech people. We're the network behind the show you're listening to right now. We have a slate of hit shows across a range of topics and industries, from our AI and investing cluster of podcasts to shows that drive the conversation in tech with the most interesting thinkers, founders, investors, and influencers, like Econ 102 with Noah Smith. We're launching new shows every week, and we're looking for industry-leading sponsors. If you think that might be you and your company, email me at erikaturpentine.co. That's ERIK at turpentine.co, and let's partner together.